Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and Bill Keen and Matt Wilson are with me again. Hey, guys.
Hey, Steve, we're in the dog days of summer, as they say, but it's going pretty well. How about you? Are you doing good?
Things are very good.
Yeah.
Things are very good. All right. Well, we're gonna jump into the episode here today. We've got a case study that we're going to explore, and I'm going to take just a quick moment here and walk through some of the particulars of this couple's situation. And then Bill and Matt, you guys are going to walk us through how do you actually address this, and what are some of the key issues, some of the key questions that pertain to this particular couple. And I will be very interested in seeing how you go through this as well. So what we have here is we've got Judy and Joe, and they're both aged 62. They're married homeowners. They have a home that's worth about $750,000. They have a mortgage of $200,000, so they've got equity of about $500,000 or $550,000 in the home. They have no debt outside of that mortgage, and the rate on that mortgage is 3.5%. They have $2 million in investable assets, and of that, $1.5 million is in Judy's 401k, and then there's $500,000 in certificates of deposit. And of that, about $300,000 of that was recently inherited, and that's included in that $500,000. Judy also has a Social Security benefit of $3,362 per month at retirement, and Joe's is slightly less at $2,803. Joe also has a $4,000 per month pension from being a professor at a local university, and there's no cost of living adjustment in that particular pension. Now, they've also indicated that they need about $12,000 per month in income net of taxes. So that's after tax. They have about $12,000 that they want they want to be able to spend. So we've got a few key questions here. Matt, I think I'll let you take it from here. And as you look at this, how do you dissect this, and where do you go with this?
Yeah, when our planning team met with Judy and Joe, we have a process that we take everyone through, and that involves typically what we call a introductory kind of phone call from our team to just get a sense of, hey, we want to make sure we've got the right tools to address your needs. So let's just get a little idea about what it is that's concerning you. And so they give some details and some background. And then of course they provide these questions. So they want to know, can we retire comfortably at 65, knowing that, okay, we're looking around $12,000 a month net of taxes. They want to make sure they invest the money correctly, so they don't run out of money, that they're aware that that's an important piece to it. And how do you structure the withdrawals? Because they're just like, well, how do you get the money out? It's a retirement account. All I've done is put money in. I don't know how to get it out. They're curious about paying off the mortgage because they would feel better having it paid for. So that was a question they posed. Again, like, we've heard that you roll the money to an IRA, but you can leave it in there. How do you do all that? They brought that up a couple of times because it's foreign to them. And then too, they're currently giving to charity on an annual basis, which is built into their monthly budget. So it wasn't a separate kind of line item, but they also said, we got a couple of kids and a couple of grandkids that, we haven't been giving anything to them, but just, is it something we should do? Or if we wanted to, how would we go about it? Our primary concern is that we're we're okay because we don't want to do anything that's going to put us in a bad position. But that was just again kind of a item they brought up. So, we go through this process where we want to take them through and help them understand the answer to these questions, but also, part of our planning process too is we're going to point out things that we identify as issues too. But I kind of wanted to say, well, let's go through this process of addressing their questions and making sure that that those are taken care of, but also like a little look behind the scenes on how we look at these things. So their first question, okay, can we retire at 65? So they're currently 62, got call it $2 million in investable assets made up of 3/4 inside a IRA or a 401k, which was all tax deferred money. They did confirm that it's all been pre-tax money. So that's important because you have the ability, and you have been for a little bit of time now, to utilize the Roth version of your 401k, which would be after tax dollars that are growing tax free. So that's the little nuance there, but they've had everything in there as pre-tax dollars. And then their CDs, that's all money that's been taxed already. It's earning a little bit of interest currently, and they pay tax on the interest that it earns, but they can access the capital, the principal, with no tax consequences whatsoever. And I point that out because that's just important from a withdrawal structuring standpoint. Where do you pull money from, and what are the tax consequences for each of those decisions? Steve mentioned the Social Security amounts that they said were at retirement. So those were the numbers at age 65. I confirmed that with our planning team. Call it $3,400 a month, just under that for Judy, and $2,800 a month for Joe. And then Joe's got a great pension, $4,000 a month. No cost of living increase. So that's going to be have less and less purchasing power over time, but it's a good pension. And that they decided early on, because he's been in his career for 30 plus years, that they weren't going to save inside his retirement plan because of the pension that that he had access to. So they prioritized Judy's 401k savings on that side.
You think that was a mistake, Matt? Or I guess you could always say more.
Well,
better,
you could
right?
always save more. So that's where, and if you're not getting a match, you're not missing any free money. It's always kind of at that. But if that was the most they could save and they did it in that vehicle and she got a match, great.
Sure.
It's all relative to the circumstances at the time. And, great to have a pension. But yes, I guess it's always
more. I wouldn't
better. Say always better, because sometimes what are they? More money, more problems. But hey, it's up. Again, you got to live your life too, not just save for the future.
So 6165 in Social Security that will adjust with inflation, 4,000 that won't. So well over 10,000 to start of monthly income without touching investments. So initially, you might say, someone looks at this and said, "Oh, surely it should work." And I'm not saying it does or doesn't here at this point in our conversation, but that's a starting point here for monthly income.
Yeah. Well, here's our, so and you've got their mortgage, which is part of their monthly, their spend there, which, they indicated was around $1,500 a month without taxes and insurance. Principal and interest is $1,500 a month, 3.5%. They had a question related to that, because they have the cash, or at least the money in CDs, thinking, well, we could use that money. We got this inheritance, $300K. Should we use it to pay it off the mortgage? They're all questions they have. They haven't made those moves yet. So I'm glad that they were able to come in and see us before they made those decisions.
Matt, when it talks about the inherited 300,000, as I'm listening to these case facts, and I specifically didn't look at this before our show today, just to have some fun with it with you two. You hear that and you think, all right, what's the catch here? Is there some catch on this? Are they looking for something on that inherited? But in this case, since it was cash they inherited or CDs, not really a cost basis issue. It's really a non-factor. Are you in agreement with me on that the inherited piece of it, other than the inherited part might have some sort of sentimental value to whoever inherited it. We do
Sure.
see that, but from a tax standpoint or tax or any type of, structural impediment, there's nothing there. Would you agree?
That's right. Yeah. I mean, if it was an inherited IRA, if it was pre-tax,
Yep.
you inherit the tax bill. But all other kind of non-assets like that get a step up in basis, and you don't necessarily have to worry about paying tax. You just have to figure out, is it liquid or not liquid, and can I sell it, or all that. So fortunately, it was all cash, easy. They're past that, so it's in their account and all good.
And no sentimental value that we have to work around that we could tell from this.
It was, considering they were using it to pay off, thinking about using it to pay off the mortgage. I don't think they're too worried about spending it. So yeah, their first question: can we comfortably retire at 65 and meet our spending goals? Well, I guess they told us the amount they need, that they feel like this is our budget that we put up. They spend a lot of time on it. Not everyone does, but they spend a lot of time on it. They've got their charitable giving involved in that, their travel, their mortgage payment. At 65, they'd be on Medicare, and estimated what that would look like. So they feel really good about their budget. One thing that we would do in our planning, we would separate those things out into buckets. And the reason is because we know, well, one, healthcare expenses inflate at a different rate. They typically, and we get this data from Medicare, for the last 20 years, it's been about double the inflation rate that the rest of consumers have had on their other expenses. So closer to 6%. So that's the inflation rate we use on that. So we want to take that category on their budget and say, well, this is going to inflate at 6%. So we're tracking it separately. Their principal and interest on their mortgage, one, it'll be paid off at some point. I mean, it's at 3.5%. They did that just a few years ago, prior to rates going up significantly. They didn't quite hit the low, because some 30-year mortgages I've seen are 2.75, 2.5. I mean, they're pretty low though at 3.5. Right. So they would have, call it 25 years still on that. But I bring that up because principal and interest is a fixed schedule, does not go up. Now there is a piece, if you do this, if you escrow, that does go up. Taxes and insurance, that does go up. So that's part of their regular budget. Travel, well, their travel bucket today, or at least their budget for travel, if we don't break it out, we're just assuming, okay, you need this amount of money for the rest of your life. However long, let's all talk about it. Longevity. What do you think? Let's figure out what's best for you. But our standard is to start with people living into their early 90s, which is longer than the average life expectancy. But most people are comfortable starting there because they don't know. Now, some say, I'm not going to live that long. And others say, I don't know, my parents are they're both 100 or up there. And It's like, okay. I mean, it's all flexible. I mean, we can't tell you how long you're going to live. So no one knows the future. So let's all, talk about it. And we make adjustments as we move through the rest of your life, because it changes. Things happen. We got to adjust and adapt as we go. But we break out that travel budget or bucket item because you may not be traveling as much when you're 85 as you were at 65. So your initial kind of thought could be significantly different in the future. So let's not just assume you're going to keep doing that exact same thing. And let's put a time frame on that. And that it's completely flexible. Again, that's why we meet every year, because sometimes it's like, well, we'd like to do a different trip this year. Okay, let's talk about that. Is it more expensive? What's that going to involve? And figure out a game plan for it. And then they've got just their base kind of living expenses from their day-to-day lifestyle with the rest of it. So that's the first step. So we break all that out. We run through a stress test. So that stress test looks at different rates of return, different orders of return, and we come back with, it's a probability of success. But what we're really looking for is like, okay, if you retire and the investments, the markets, they go down for the first 2, 3, 4 years, how bad is that? Like, is that really detrimental to your plan? Or they go up for the first 10 years and then they go down for the next 10 years and they go up for the last 10 years. How does that? We run 1,000 different simulations like that to come up with this probability of success. And we also use an investment portfolio. We tailor it to what people's, we use the word risk tolerance, but really their ability to kind of handle volatility or market fluctuations, because some can handle it more than others, and base our assumptions on a portfolio that's structured that way. However, we have two ways of looking at it. We can look at, well, how is that portfolio that's been like that performed in the past? So we call that historical, versus, well, let's project out what that could be in the future and be more conservative than what the historical is. And so our baseline, again, our default is always to start with the projected. So a lower rate of return with the same amount of volatility or fluctuation. And we do that because we'd much rather have happy surprises in the future than, well, there's a 50%, you can retire, but there's a 50% likelihood that you're going to have to go back to work. I don't know how many people would take that, chance, but if we can start conservative and it works really well, then we feel very comfortable that it's going to, really get through any scenario that we haven't stress tested, especially if it's structured correctly and, emotionally you're able to handle it, because that's the other key aspect to it. So we run through that. Yes.
I want to go back for a second here. You talk about this probability of success. I want to make sure that people are clear on that. So what is the sort of the range of probability of success that you like to work with? And what happens if you run it and it comes back and you're like below the minimum acceptable range? Then what do you do? What do you tell the person?
Yeah. So that probability of success. So, and that's a good thing that you bring up, Steve, because it doesn't mean the plan ran out of money. If their probability of success was a 80% or whatever, that 20% of them ran out of money, what it means is that, well, you weren't able to do exactly what the plan says with no adjustments. So what that probability really is indicating is that the lower the number, the lower the probability is, the more likelihood that there needs to be changes to the plan in the future. Well, we can pretty much say that there's probably always going to be a change of the plan, but okay, if we go through more adverse market events, or if you have more unexpected expenses, we're probably going to have to figure out a way to maybe spend less as you get older, which isn't necessarily uncommon, but let's just be aware of that up front. Now, hey, investment timing, markets could be great and never have to worry about it. But the range, it's age-based, Steve. So as someone gets older, the length of time that the money needs to last is much less. So you could pretty much, think of it that way. But that range for most of the folks that we're starting this in-depth planning process with is between a 75 and 90% is what we call the optimal zone. Anything below 75, and still, if someone really wants to retire, again, it's their money. They're using us to advise them what our opinion is and help them figure it out. And let's say it's a 70 or it's a 60%, and they're, as long as they're comfortable knowing that there could be a chance where we recommend you spend less. Now, again, you can do whatever you want, because we have some clients that have told us, look, if I run out of money in 10 years, I run out of money in 10 years. I want to do this now while I'm young and healthy. And that's like, hey, good. I mean, you're aware, and because that's our job. We just bring awareness, not tell them well, no, you can't do that. It's not going to work. It's like, well, I don't live their life. I don't know what's important to, we talk about it, but they have to make the decision. And if they're asking us, well, should I do that or not? We'd have a recommendation to say, well, if, it's risky to do that, but it's definitely an option. And hey, things could go great and you never have to worry about it. Things could need to be changed in the future, and that's okay too. And especially we kind of run some of these worst case scenarios. Well, okay, let's say you run out of money and all you have is Social Security. Let's just go through that thought process.
Yeah, in this case, they'd have 10,000 if they ran out of money.
Yeah, like this couple, they've got a really good base income coming in. So what we did is, okay, we ran their plan. They came in at a 98%. I mean, when Bill pointed out the pension and Social Security covers majority of their income, it's like, okay, yeah, it's probably not going to be too big of a stretch to say they can retire. So now the conversation shifts to, well, would you like to retire sooner? Because now that's a variable, because your plan is so strong. Because in my answer to you, Steve, I said the optimal is between 75 and 90. And someone might, well, why isn't it 100? Well, because we
steal
can't
your thunder. If you weren't going to go there, I was
tell you what the future is. So there's no, there's never 100% probability when we're talking in markets and these types of things. But then between 90 and 99, because 99 is the highest, all that means is that you've got a ton of flexibility in your plan. So if you're not retired already, you could retire sooner. You could spend more money. You have more money left at the end, which may or may not be a goal for you, but there'd be more left over. If you're worried about, and we can make up any kind of adverse event, Social Security going away 100%. You've got enough, we can test for that. Social Security gets completely eliminated.
He's not predicting that. Just to be clear, it's just an example.
But it's a way. It's a concern people have. Let's see how dependent is your plan on Social Security, or how dependent is your plan on the pension. Like we can really run those stress tests, and come up and really evaluate. It's like, and if those things happen, you'll be fine. Now you may not like it, but you have the assets to live on and handle that. So, that's what's important about the planning and walking through these scenarios, because what we find is that a lot of people realize they can retire sooner than they thought. Mm-hmm. Now, retiring at 62 does bring up a different issue. It's that, okay, well, now we have to pay for health care prior to Medicare. And we model that in and we show that, and we can, hey, here's how the exchanges work. We can walk through subsidy planning for the healthcare exchanges. Now that is changing a little bit on those subsidies with the new bill that passed recently, a new tax bill, but there still exists. They're just going back to the old way. So it's, again, we know how to plan for all that. So all of our clients that are dealing with that, we've got that covered for you. But we just walk through how that works and the cost associated with it. It's a limited period of time while they would have to pay a little bit more in premium to cover that. But we plug that in when these things come up, because that wasn't something they were aware they couldn't get on Medicare, but they didn't know what the choices were and how it worked. The other big question to them was like, okay, well then how should we take distributions? How do we spend the money? Like, do we just live off the CDs? Do we leave the money in the 401k? Like, how does that all work? Well, yes, those are all options, but let's kind of walk through what makes sense for you. I mean, when we structure investment portfolios to withstand all the market fluctuations that we've seen in the past and can project in the future with our modeling, we want to make sure that we have enough money set aside in the entirety of the investments. Depending on we'll structure the account type based on the tax ramifications, but let's look at just the overall allocation. So that's the breakdown between stocks, bonds, and what types of stocks and what types of bonds. Like, that's allocation. And we want to have enough money where we say, like, let's just start with 5 years of your income needs, not subject to the stock market volatility. So that would be invested in short-term, bonds, fixed income, we call it, things that generate interest that have short time frames because they don't have as much interest rate sensitivity, meaning if interest rates go up, you're not seeing a bunch of fluctuations with those investments. They're very, very stable, earning some interest because we know markets are going to go down. They go up majority of the time, and long term, they go up 100% of the time, right? I mean, there hasn't been a period of time where they went to zero. Individual positions have, but markets haven't. So we want to be, take advantage of that, but we have to have a way to weather those periods where the markets are down. And sometimes they're down for a few months. Sometimes they're down for a year. Sometimes they're down for 2 years. They're not, doesn't happen on a clock. No one can predict it. We can talk about it. My webinars where I talk about the market, I go through, well, here's what I see and here's what could be happening, but let's just talk through probabilities, because a lot of it's just probabilities, and how we structure the investments so that we can earn enough. You need to earn enough to make sure that you're covering the increases in your cost of living as you get older. Like one thing that we pointed out was that, and the reason we pointed it out was that Joe's pension has no cost of living adjustment. So over time, it's worth less and less and less. And, if our listeners, if you have parents that are still living, one thing that you should ask them if they happen to have a pension is ask them, and you may already know the answer if they've been retired for a couple of decades. Well, how much is their monthly pension if they have a pension? Because most likely it's probably doesn't have a cost of living. It might be less than a couple $1,000s. Now, 20 years ago or 30 years, that could have been great. But now, it doesn't go as far as it, you think about that. And it's just interesting to think about. And you can look at the cost of a home. I mean, that's front and center, and it gets a lot of discussion that, well, homes are too expensive. I've heard clients say, well, yeah, we bought our first home for this, and gosh, you can't. And it's like, yeah, that's inflation. That's the definition of it, is things cost more as time goes on. And so you've got to have a strategy to make sure you can harness that.
Think about 3% interest with the old rule of 72. Like if these people needed $12,000 a month today, if it 3% inflation would just about double it. So
that's right.
It's mind-boggling to sit here and think that they would need $240,000 a year after taxes 25 years from now, if indeed the spending is dollar for dollar the same, purchasing power. Maybe to your point, it's not because they're spending less as they've gotten older, which is a trend we see a lot.
Yeah.
But in the example we're making, $240 net of taxes a year. Yeah, they better have some money in some equity investments that can grow over time and subject to some volatility. That's okay. That's okay as long as there's enough outside the actual more volatile investments to live on when things are down for a year or two.
Yeah.
It's just a smart way to do it. And earlier when you mentioned, you said people are able to handle volatility. What I really wanted to key on that for just a moment before you move on. He didn't mean can their plan handle the volatility from a number standpoint. What he meant was, can the investor emotionally handle seeing volatility? And usually when we say volatility, it's when the markets are going down for some period. The news is telling you the world's coming to an end. We've been through, all of us, every one of us listening to this, us speaking on here, watching. You've all been through it. You've seen it all. You've seen a lot in your time. Some of you have been paying attention to it longer than others, but if you've been on the path, you've seen a lot of things negative in the news, the economies, politically, globally, and you've seen how this plays out. So there should be a baseline level of faith there in the system for most part, but everybody does have their limit to kind of what they're comfortable with. And we try to speak about it in ways people can understand it. Like he talks about 5 years set aside. What set aside means in fixed income, like he said, to get you through those down markets, to get those down periods, so you don't have to sell at a bad time. So this is what he means by, can someone handle volatility? And as professionals, we have to be able to tease that out with each client. One, help them understand it, educate them like we're doing right now today, get more comfortable with it, but then ultimately see where you land on it over time and be able to advise you accordingly around it.
Yeah, because for most folks, they've never been retired before until they retire. So it's different. You've worked and saved and maybe weren't worried about it. Now you're pulling money out. To use a climbing example, Steve will appreciate this. It's like the hardest part is coming down the mountain, not going up. I mean, more accidents happen coming down, not on the way up. So it's really important that this stuff is structured correctly.
Matt, how many of the smartest, we work with a lot of very smart people from all industries, but if you've listened or watched for very long, you know that we have a kind of a niche expertise in the engineering community, working with engineers and professionals in the architecture, engineer, and construction world, all industries really, but just kind of an unusual proportion of those folks and employees and team members of those firms. So I would call some of the smartest people anywhere. And they say that exact thing, that they've been doing it kind of on their own while they were building wealth and watching it over time. Everything was kind of on autopilot, but they realized I've had more than one tell me we're smart enough to know what we don't know. And we're smart enough to realize we've made it okay now. We've got ourselves in a good position, but we've never been retired and had to handle all this. Like Matt just mentioned, you just hit on something important. So we do not know how we're going to react and respond when stress hits, when maybe I'm going through an illness or one of my kids or my wife or husband. There's a lot of these moving parts that can happen. Things can become emotional. And now we've never been retired before. We don't have 40 years to make this money back if we were to make an emotional decision or just simply miss something. Like remember last episode, we had we had a bunch of tax attorneys and CPAs here at our office studying the tax regulations. Our clients are smart people, but they don't want to track all that stuff. No. And they don't want to have to, find the intersection of all those rules and regs between the intersection of their emotion and then put their life savings at risk, doing it. Most don't. I suppose some might, but most say, I want to delegate this to you all and partner with you because we don't want to take the risk. We want a system and a process.
That's right.
Which is so good that you're going through this today because it's demonstrating, as I sit here and think about it, some of the depth of the process. So please, Matt, continue.
Yeah, sure. Their other item that they wanted to discuss was paying off the mortgage. Just they're curious. We've got cash. Should we do that? The interest rates are roughly the same, 3.5% interest on the mortgage, 3.5% on the CDs that they have. And we walked through the scenario with them and ran the plan, and it really didn't impact the plan in a negative way to take that money out of their account and pay it off. However, what we discussed with them is, it does impact some of the planning options. So it's one thing just from a high level to say, hey, you're in good shape, you can do these things, it works. Now, if we want to optimize it or look at ways to optimize it, is this the most optimal thing to do with the cash and to pay off the mortgage? Well, again, we know principal and interest is fixed payment, doesn't go up with inflation. 3.5% on a mortgage is pretty low. We may never see as low of mortgage rates ever again. They don't plan to move, so that's a non-issue for them. And it's like you got it locked in. It's not going to go up. That rate's going to stay the same. Your payment's going to stay the same. Interest rates can go up. They can go down. The CD investment rates and part of when in my last discussion about structuring the investments, it's like the CD, isn't necessarily the best vehicle for that amount of money because one, we're going to be spending some of that because we want to structure their withdrawals using a combination of their after-tax money, which is the CD account for them, and their tax-deferred money, which is the 401k or IRA when it rolls over. And if you were to take a big chunk of that after-tax money or the CD money out, that's going to be less left there for you to spend. And then more you're going to have to take out of the IRA. So it's going to change your tax picture and some of the planning tools that we're going to look to utilize. Like one of the things related to the rollover, what do we do? How do we get access to this 401k? Well, you can leave it in there. I mean, that's an option. However, you're limited to whatever the investment choices that are in there. And for them, they just picked a target date fund because they didn't know what to do. They just picked a target date fund. And we looked into it. It's way too conservative, even with like us discussing with them what they were comfortable with, it was more, and they didn't know. It just it says target 20 2030 or 2025. It was one of those. They picked it. I don't know, it just made sense. But it was, and each of those target date funds are all different. Whether it's target retirement date or some other structure. If it's a different owner of the fund or different company that's running the fund, they all do it different. There's no standard way. So really, you got to do a lot of research to understand how those things work if you're going to do it yourself and utilize those things. So we talked about that. And then 2, when you leave the money in the 401k, you don't have near the flexibility or control over withdrawals, taxes, how to handle required minimum distributions relative to other IRA accounts. If you want to have a coordinated investment and tax planning strategy, it's really hard to do that when that account's over there. So for them, we discussed typically what a lot of people do is they roll the money over to an IRA. That gives them more flexibility from the investment choices, that allows us to work with them and handle the investments for them. It allows us to do all the tax planning that we do on a coordinated basis. And that is tax withholding and being very, very precise with the amount of withholding versus 401ks. It's common for them to just withhold 20% federal and 10% state. Like 10% state. I mean, that's way too much for Missouri and Kansas. We're at not enough for California, but whatever. That's just the rules, and that's what they say. Right. And 20%, it's like, well, that may be way too high. May not be enough, but. And I've seen some 401ks where you can only take distributions quarterly. So you got to figure out how much you need each quarter. And anyway, that's a big hassle.
You could also have various ones too. You have 2 or 3 here. You had prior jobs. And
well, now you got to figure out what are the beneficiaries in all these accounts and
RMDs from each one. And we haven't even talked about that here because they're not at that age here yet. But
yeah. So we also, as part of our planning, is like the high level, we're going to talk about, does this work? But then 2, okay, well, how do we optimize it? As I mentioned, okay, so withdrawal strategy is a big optimization. And 2, utilizing your after-tax money to live on while at the same time generating taxable income by taking distributions out of your IRA, but not just, putting it in your after-tax account, like putting it back in the CD account to replenish it. What we would do for them is look at Roth conversion. So let's live on the after-tax money, but let's take some of it out of the IRA. And again, this is a tax calculation. We're running this tax calculation every year. So sometimes the Roth conversion's a little bit higher than other years because there's different variables, but every single year we're evaluating this and taking the money out of the tax deferred IRA, paying the tax, putting in the Roth, and it grows tax-free for the rest of your life.
Yep.
And that's, we can quantify that in terms of tax savings based on what the inputs that we put in the plan. Like for this couple, okay, they're going to live out into the early 90s. They're going to have it invested in what we would call moderate portfolio. They're going to have this spending level, and we're going to project it in the future with our inflation assumptions. We're going to project out what the future required minimum distributions are going to be, what the interest and dividends that they have to pay tax on in their taxable account. So we're going to do all these projections, what the current tax code is, and we can actually evaluate, does converting money to a Roth IRA actually save you money over your lifetime or not? And for this couple, based on those inputs, it was projected that they would save nearly $180,000 in tax
on that one decision.
Yeah. On, converting money to the Roth IRA over a period of time.
So, Matt, I want to ask you here, we just had the one big, beautiful bill passed here recently, and I don't think there was much of an impact on the tax rates because I think it was pretty much going to continue the tax rates in existence. Yes. But were there any changes in there that would affect the Roth conversions in terms of the desirability of those, or did it change any assumptions so that you had to rerun whether the Roth conversion still makes sense?
Yeah. It's a good thought because it's like, well, if we're getting some tax changes, does this help or hurt that strategy, these tax changes? Well, one of the things, because like you said, there's not significant change to the tax rates at the bracket level because those pretty much stayed the same. They just became permanent versus sunsetting. So it provided clarity at least. Okay, we're not going to have a tax increase at the end of the year because that was essentially what it would be for most brackets. So that went away. But the thing that it did was for some folks that itemize, it actually made it better because they have more tax-free money now because they increased. The biggest thing that's I think going to be the move the needle for most of our clients is they increased the state and local tax deduction. It was capped at $10,000. Now it's capped at $40,000. As long as your income wasn't over the threshold, which we talked about in our last episode. So that's more money you receive tax-free, which means that's more money you can take out of your IRA and put in your Roth IRA and pay less tax on.
Yeah. Okay. And then some of the additional, what do they call them?
Yeah, age 65 deductions.
65 deductions, yep. I guess.
Yep, that
whether
was on top of it
or not,
too.
I think, right?
Yep,
Wasn't that right from last episode?
That's right.
Mm-hmm. Okay, what is the one variable that has the single biggest impact on whether or not it makes sense to make a Roth IRA?
Yeah. So the biggest thing that I would say is what it's the tax ramification. So it's like, what bracket are we in today? And how much tax are we paying today? And how much tax do we think we're going to pay in the future? So for example, if you have, I'm just using a round number, $500,000 in an IRA, and you don't spend a whole lot of money. Maybe you live on Social Security and that's $2,500 or $3,000 a month. You're single, you're just never married, no kids, like just simple lifestyle. And you might you just want to make sure you're not paying taxes. Like that's fine. And you want to convert money to a Roth IRA. Well, just off the top of my head, and I made up that example here on the spot, that person's probably paying very little in taxes until required minimum distributions start. Like, because if they're living on Social Security and they don't have any other tax sources, it's tax-free. And the deductions are in such a way that they're paying, I would say it's probably zero in tax.
Mm-hmm.
But they have $500,000 in a tax deferred account, and you don't have to pay any tax until they start forcing it out, which is at RMD age, which is 73, up until 2033, and then it's 75. So It's moving in the future, but that you're not at RMD age yet, but you will be in the future. And you kind of, you'd think, okay, well, I got to pay some tax in the future. I want to minimize that by converting money to a Roth IRA. Well, if you're in a 0% bracket, and if we did the estimate on what your RMD would be in the future, you're probably still in a 10 or 12% bracket max, which is the lowest two brackets based on your RMD. So if you were going to take out enough to put you in the 22% bracket to do the conversion, that wouldn't make sense. Like so it's like because we have sometimes some people like, well, if putting it in the Roth's great, more is better. And like there's a point where you're paying too much in tax.
Mm-hmm.
And now this is based on current tax code and where we think, like if someone thinks, well, I'm afraid they're going to raise or double or triple taxes and the rates and brackets. Okay. That's a assumption we can plug in, that if taxes raise significantly, at least you've eliminated that risk from that, from the Roth IRA.
And that's where I wanted to get to that point right there, in that how important is it in determining whether it makes sense to do a Roth conversion is your opinion or your assumption about whether future tax rates are going to go up, are going to stay exactly the same as they are today, or are going to go down. And when you typically do a Roth conversion model, do you do all those different assumptions? Do you say, hey, we're going to assume tax rates go up by this amount, or we're going to assume they stay exactly as they are today, or we're going to assume they drop by 20%?
Yeah.
Do you do like different models like that, or how does that work?
Well, so we don't necessarily have to do different models, because what we can do is use, if you're in the 22% bracket, well, if we can say if you were at the 37, so that's almost a double. well, that wouldn't make sense if you were converting in the 37, or if you were down in the 12 and it doubled to 24. Well, that would, so within the current tax structure, we can see, well, where are those bands on where does it make sense? Because if it doesn't make sense at the 37, but it does at the 24, okay, you can kind of say, well, what's that look like in the future from there? So that's where, when we look at it, it's like, it's common to say anything above the 22, 24, it just has some more risk associated with it because you're paying a lot in tax today. And how much higher in the future do you think they're going to be than that? There's a lot of variables, but if you think they're going to be at 37, and we can run a straight 37, we can plug in any number. So we can say, well, taxes are 50%. What does that mean if you were to convert today at 22 and they're 50% 10 years in the future? That
and when you say like 22%, you're talking
the federal level,
right? And are you talking your incremental rate
That's right,
is 22%, or your average effective rate across all of your taxable income is 22%?
We're talking the marginal, because any Roth conversion is at that incremental rate. It's at the bracket you're in, not at, we can average it all out, but the tax is based on the bracket you're in.
Right.
And that's where we look at that, because, there's back of the napkin rules of thumb when we've talked about this on the podcast and different webinars and seminars, like, look, you don't have any fancy software. I mean, just a thought is, if you're in the 22% bracket, look at the top of the 22% bracket and say, well, what if I converted 20 grand? I'm still in the same bracket. I didn't increase into a different bracket. Did I trigger any IRMA surcharges or Social Security taxes? I mean, again, you'd have to be a little bit more sophisticated to figure that out, but people can do that. And it's just a way to think about it.
Okay.
Yeah.
And maybe another strategy too, I'm sure you've come across this, is, let's say you got laid off and you were out of work for 6 months or 9 months in a year. You have very little income that year. That's a great opportunity to do a Roth conversion because you have very little income that year.
That's right. So the key times, or at least the thought process is, you have low income years if you're retired before you start Social Security, because that's less taxable income. Now, if you're living on your investments, you got to figure out, okay, where am I going to take that from? So like with Judy and Joe, we talked through, well, if you start Social Security at 62, assume you retired at 62, started at retirement at 65, delayed it to age 70. Well, if you delay it, you're going to have to take more out of your investments, but you've got enough saved to where that's not going to hinder you. You're going to get more from Social Security in the future, but that also is going to allow us to do more Roth conversions, because your tax ramifications are less on those Roth conversions because you don't have the Social Security income. So, it's before RMDs start, because RMDs now are forced distributions. So you have taxes associated with that. You can still have a Roth conversion post RMD. It just has to be over and above the required distribution. So again, all these nuances but we can model all those scenarios in and look at it and say, okay, well, let's model it in. Let's look at processing Roth conversions for the first 8 years before RMDs kick in. Let's look at no more than the 22% bracket. Let's figure what that's going to be. Where does that put us on the IRMA surcharges, if any, which is the Medicare additional tax or additional cost if you're in a higher tax bracket, and show, well, the Roth conversion is, maybe it only saves you $10,000, and you're like, that's not worth the complexity or the risk of paying all this tax. Let's just leave it alone. Okay. But we have to do the analysis to be able to determine where that comes in at. And in this case with this couple, where we're like, hey, this can nearly, based on, again, all of our inputs, nearly $180,000. And two, it's going to leave more money in the Roth bucket at the end of your plan, which is tax-free. And the longer you can have it in there tax-free, the better at your end of the plan versus more in the IRA. So that's better for your beneficiaries because they receive this asset tax-free versus, they're not inheriting a tax liability with the IRA, the tax deferral. So those are the benefits that they really liked. And then it's okay. That's big picture, even though that's still a lot of detail. But then it's okay. Now, what's the exact number this year? And that's where now we get into really detailed tax planning, where it's as close as you can get about putting really a tax return together for someone without putting a tax return together. And we're going to figure out exactly the inputs. What are the taxable portions of your investments? How much is taxable interest? How much is not? What is the Social Security tax if you're on that? And then we can get very granular on how much we should have on the Roth conversion on a year-to-year basis, based on all that, and plus based on, well, now with the new bill, we've got a 3-year window on a lot of things that are going to go away. And so, we're going to have to reevaluate all of our strategies again.
So we'll have this conversation again 3 years from now.
There's always something to talk about. That's for sure.
There is. And that's why this podcast will go on in perpetuity.
That's right. That's right.
Wow. What an episode today. And I really appreciate the detail that we had on the inputs to this plan so that we could actually dig deep. And Matt did just a fantastic job going through the discipline process that we put into place here as we sit down with our clients and then folks that we're evaluating if there's a fit for us to help them. And one thing that is really important that I wanted to key on is, and I bet if you're listening or watching this, you intuitively know this, what I'm going to say, but the data that we get from our clients and the folks that are talking to us, what we can give back to them in planning tools and opportunities is only as good as the data that they provide us. So when you're meeting with a financial planner out there or a financial advisor, and there's so many different folks that call themselves financial advisors, really be looking at what they're asking you to provide them with respect to your data. And you have to get comfortable with this now because, when we're asking clients, and again, new folks that are considering our firm and that we're evaluating if we could work with them as well, we're asking for things like tax returns. We're asking for you to take the time to inform us what your income will look like this year, to provide paycheck stubs, to provide what your tax withholdings have been, to provide information what you think these things might look like in the future. If you have rental properties, what does that look like? What do your deductions look like around those things? And we have experts on staff that can review tax returns and get a really good some real good visibility into how we can execute on these planning opportunities. But a lot of firms aren't looking at these things in this much detail. So all they're asking you for is your account statements. How much money do you have? And now, of course, that's important, how things are titled. Matt went into that so well today, the different tax-free, Roth, IRA, after-tax funds, the CDs. Those are all very important when we're building that mock tax return and thinking about you today and in years to come. But I hope this case today helped you all think through the different nuances, the different angles we're looking at. And I was so hard because Matt so sharp about this, and all of our planners are just the same when they're walking through these things. But so many times throughout this conversation today, you would hear him say things, well, with an acronym form, RMD, QCD, other things like this, which is, hey, if you've listened to us long enough, you should know what those are by now. But and you likely do. But that one decision that you make over on what you might think is the opposite side of your financial plan may have a cascading effect over onto 2 or 3 other sides of your financial plan that you may not have ever pieced that together or connected those dots. And it may not have affected you this year, but it might have 3 years from now, and then maybe even for life. So there's so many things that go into this. And I think every so often doing really a deep dive case study like we've done today can demonstrate, hopefully give you all an idea of the things that we look at, or I think any good fiduciary financial team should be looking at. And if you're attempting to do this, on your own, or at least have an understanding of how all this works so that you can come in as an informed consumer and partner with us on it. I think it's been a great to spend a little bit extra time on this episode, going through the details here and giving you kind of a summation of how we think that these two nice folks would be able to proceed in their lives.
All right. Well, Bill and Matt, thank you as always. And for each of you listening, if you have any questions or comments, please check us out at keenwealthadvisors.com. And if you have a specific question you want us to talk about on the podcast, please shoot that over to us as well, because we love to do listener question episodes too. So appreciate that. So guys, as always, thank you. And we look forward to seeing and hearing all of you on the next episode of Keen on Retirement.
Thanks, Steve. Thanks, Matt.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.